Welcome out to the BluSky Trading Lab, ladies and gentlemen. This week we are going to be covering trading gaps. That's a conversation that came out of our swing trading discussion over the last few weeks, and we kind of discussed this last week in the lab, and to put together a little bit of a presentation on understanding gaps and the different commonalities in gaps and the differences in gaps to help us understand kind of where the next move in the market is. Now, I always like to kind of get a lay of the land as we kind of just get going in, as we're starting to learn a little bit about this topic. And I like to scale it 0 to 10. 0, you know nothing about gaps. 10, you're an expert wizard at gaps. Where would you categorize yourself from a technical understanding of trading gaps? Nacho negative 10, Asher 9. Let's get some more answers. Big Al, you're a 7. WD 50, better than 30, you're a 3. Link, you're a 2. So we got some pretty decent understanding, some lack of understanding, and what's the goal here? We talk about this all the time. What's the goal in this lab every single week? What is our only goal in this week every single week? To take wherever you're at, if you say you're a 2 or a 3 or a negative 10, and to see that inch up a little bit, right? To fill the gap link. There you go. Love it, love it, love it. He needs some likes under that comment. That was absolutely fantastic and beautiful link. And that's exactly why we're here, to fill that financial IQ gap. No doubt about that. Now, I first learned about gaps the hard way. When I first started learning how to trade, a lot of what I initially first started doing was trading in the options market, swing trading on equities, and quite frankly, my first 3 trades were all call options trading on earnings. And without judgment here, I would judge myself, by the way, for that, but without judgment, I didn't know any better, to be quite frank with you. All I knew was somebody told me that this company was announcing earnings, and if the company goes up, you can make a lot of money. That's all I knew. I probably would have ranked myself at a 0 on the financial IQ and understanding earnings, understanding gaps, but there I am, just a young, hungry trader, wanting to learn how to do more things, wanting to learn how to make money, wanting to make money. And so the first 3 trades I ever made was all on earnings positions back in October of 2005, and they were all on gapping situations. And the first 2 times it did it, oh my goodness, worked out handsomely. The third time, we're not going to talk about it because it wiped out the first 2 times, and it did teach me some extremely valuable lessons. And the number one most extremely valuable lesson that experience taught me was I needed to know more about gaps. I need to understand the behavioral analysis, the technical analysis, the causation of the gaps. But what's most important about gaps is not what you're doing in front of a gap, because it's hard to predict that unless you're dealing with an earnings conversation. The most important thing about understanding a gap is, what does it mean for the future? Everything we do from a technical analysis perspective is to understand the future probability outcome. You know, I watched Mike navigate the lower time frames today on the charts. You know, looking at the bottoming formations and calling out the technical levels. And I've said this before, but I'll say it again. I cannot tell you how impressive it is to be able to verbalize everything that you're seeing on the chart the way Mike does. And everything Mike's talking about there is, all right, here's the new bull level, here's the new bear level, this is what they need to achieve, this is what the bears. Mike's probably thinking he's positioned bullish, he's positioned bearish. He's just trying to help you guys out to understand exactly where that next direction is. That's everything we do from a technical perspective, is trying to understand how the history helps us understand future expectation. The most important part of that is the actual future expectation. So, what is a trading gap? A trading gap is nothing but the space between 2 candles on a chart. That is all it is. It's what happens on the overnight action that has to get priced into the market on the initial opening price. Now, everybody here understands that, because you guys look at futures on the overnight action. But a lot of people outside of the day traders and the blue sky community, they don't understand that the markets are 24-hour markets, and it basically trades a 24-hour time frame, and things that happen on the overnight action have to be priced into the market at the initial cash open. That is the gap. And a lot of times when you look at gaps can obviously happen on the top side, gaps can obviously happen on the downside. Not every gap is created equal. Now, there's a couple philosophies that I've heard in gap analysis over the years. The number one thing that I've heard is that gaps fill. Gaps fill. What that means is that the space in the chart here that is the gap, that space will be filled over time. Now, is that a true statement? It's certainly a cliche in the market, but is it a true statement to suggest that all gaps fill? It's not. It's not. Now, the majority of gaps certainly do get filled over time, over the longest time frames. But guys, there's gaps on Meta that have never been filled. There's gaps on Nvidia that have never been filled. There's gaps on Tesla, Microsoft, Apple that have never been filled. And so, yes, there are. It is true that a majority has a gap down to 500. Oh, RQ, the amount of pain in the world, my friend. But it is true that a majority of gaps do fill, but that does not mean all gaps fill. It's important to understand that there are different variations of gaps, and it's important to understand the different trends and the different patterns that are going into gaps, because gaps certainly can be catalyst events, because oftentimes what creates a gap is a catalyst event. Oftentimes when we see a gap in price that is radically different than the previous day's close to the next day, it's usually because we did get some very important information that is coming into the market. Can anybody tell me something that could occur on the overnight action to create a gapping situation that stock traders have to deal with on a day in, day out basis? Just give me something that could create it. News reports, labor market data, inflationary data, absolutely. DeepSeek coming out can certainly do that, Jaja. Absolutely. Tipped a Japanese bank surprise rate increase, which will shock everybody in the market and trigger a carry trade unwinding situation, will absolutely have a massive impact in the stock market. The number one. A Trump tweet, yes, can create a gap in the market. We're going to have to put a Trump tweet up there legitimately with the Bank of Japan sparking a massive carry trade unwinding. Yes, that's where we have to put the Trump tweets at this point. All of those can create a gapping situation. Most of those, we know that they're coming into the market. Not a Trump tweet, not a Bank of Japan surprise rate cut or rate hike. But most of the time we get gaps, guys, it's based on known events in the market. The unknown events that create a gapping situation are when news legitimately just comes into the market. But most of those things are earnings reports, well known. They know exactly when they're coming into the market. Yes, I would consider an earnings event as a known event. Now, do we know the outcome of that? No. The same way we don't know the outcome of what the labor market. By the way, when we get the brand new labor report in December, when it brings us 3 months of data, is that going to be a gapping situation? Most likely in the market. Absolutely. It's a known event. It's going to create volatility. That volatility is going to be before the market opens. You're going to see a gapping situation. The number one thing that creates a gap is earnings. The number one. There is not a close second. The number one reason a stock will gap is because of earnings. The number two, usually economic reports. Number three kind of goes down a little bit, but those would be the unforeseen international events such as the Bank of Japan, such as the Bank of London, such as the, Swiss National Bank or something along those lines. But my point is, most times a gap occurs in the market. We know there's going to be a gap, and it's our job to not try to get in front of a gapping situation because those are 50-50 coin flip situations. You don't know the data. You don't know how the market's going to respond to the data. You have no probable edge. And in trading, you have to have a probable edge, which means you don't get in front of the gapping situation when you have a known event. You look to read the price after it. And that's where understanding the different variations of gaps can really help us understand the totality of the environment to help us understand where the next move in the market is going to be. So once again, all of those are causations for gaps. Now let's get into the specific types of gaps. When you look at gaps in the market, there are four basic types of gaps. There are variations to these. There are more than these, but these are the four core gapping situations in the market. For example, one that is not listed here would be a catastrophic gap. Now, a catastrophic gap could just be a breakaway or a runaway gap, but it has a little bit more volatility to it. A catastrophic gap is usually when something along the lines of the CFO of the company comes out and the FBI has them in handcuffs because they have been lying on earnings reports. That's a catastrophic gap. Exactly. Everybody hits the sell button, news hits the market, but for the most part, the types of gaps we really kind of deal with are common gaps, breakaway gaps, runaway gaps, and exhaustion gaps. Those are the four types of gapping situations that we look at. Now, let's go through each one of these to kind of understand them individually. Common gaps are exactly what they refer to as. They're common. They happen all the time. They are not based on news necessarily that is coming into the market. Common gaps don't break trends. They don't break patterns. They don't change the overall landscape of the market. They are based on a simple understanding of the imbalances between the buyers and the sellers that happens on the overnight action. Very similar to the imbalances we get the 10 minutes before the cash close. So every day that we're in power hour, the last 10 minutes of the trading session, do we typically see a little bit more movement, a little bit more volatility? Yes or no? Yeah, we do. And that's based on imbalances that have to be balanced out. It's kind of like a cash register at a convenience store. You got to balance that out at the end of the day, and so you're going to get a little bit of a pump one way or the other. That same conversation happens at the beginning of the market, but people just don't put it into that type of lens. But you have that same thing happening on the overnight session where you have all these orders coming in, buy, sell throughout the entire world in the US stock market. And a lot of times there's a simple, imbalance between the buyers and the sellers, the bulls and the bears, supply and demand, however you want to categorize it. But there's a little bit of an imbalance there that has to be fixed in the market. And what we will see is we'll see a gap at the very open of the trading session on individual components, not necessarily the ES or the NQ. Those are very highly liquid and obviously trading in front of the market open. But what you will see is a lot of times just a little bit of a gap up, a little bit of a gap down that immediately starts filling because the only thing that is an imbalance that has to be fixed in the market. And so common gaps are not something that we really concern ourselves with necessarily as much as traders. You could be looking for a gap fill situation similar to an orb or something along those lines, but it's not something that I'm really focused in on a day in, day out basis. The same way I'm not really going to kind of sit all day long waiting for imbalances at 12:50 my time, 3:50 your guys' time. I'm just going to let them kind of play out. The Enron story did have a catastrophic gap, and it was based on the restating of earnings after they were basically caught lying. And 3 months, and it was done on an earnings report tipped. 3 months before they had that report, they had reported their best earnings environment in the history of mankind. And it dumped. The stock dumped hard because all the insiders were selling as much as they potentially could while they were telling the rest of the market to buy everything they could. And so that gap down was one of the more historic ones because it really did prove kind of the environment that was going on that Enron situation. Now, so common gaps happen frequently. We don't put a ton of time into the understanding of it. We don't put a lot of thought process into it on a day in, day out basis. It's all part of kind of the volatility at the cash open, quite frankly, that we already see through the orb and waiting on the opening range and all of that. That takes into account kind of what these common gaps are doing as they it brings some balance into the market at the very first of the trading session. So common gaps, we don't care necessarily that much about them, but they do have a tendency to fill. They're intraday analysis. They have a tendency to fill, and then we get back into the normal course of action. Now, the other three gapping situations are a little bit different here. And I'm going to cover all three of these from a definitional perspective first. And then I want to go into the market and look at some recent stocks that have had gaps based on earnings. And what we're going to do is we're going to identify, is this a breakaway gap? Is this a runaway gap? Or is this an exhaustion gap? It's really those three gaps that we kind of debate because two of them mean the same thing and one of them means the opposite. So let's kind of look at these just from a definitional perspective, and then let's go into the market and look at a few case studies to identify. And this is a really good time to look at gapping situations because we just got done with earnings season, and earnings season is going to create a gapping situation for a lot of stocks in the market. Now, a breakaway gap is the type of gap that often marks the start of a new trend. And the reason it starts a new trend is because a breakaway gap has to break something. And typically that something that a breakaway gap has to break is a pattern in neutrality. That is the beginning point of a new trend. And so when you look at a breakaway gap, for example, oftentimes the commonality in a breakaway gapping situation is you have two different parts of the analysis that you have to focus on. One is the trend and the pattern going into the gap, and the second one is the price response after the gap. And so the first thing you look at is what is the trend and the pattern going into the gap. In a breakaway gap situation, oftentimes you're dealing with some degree of neutrality. You're doing with some degree of just consolidation analysis, whether that's on the daily chart, the weekly chart, the intraday, doesn't matter to me. You're dealing with some degree of neutrality. And the gap breaks out of the resistance level. It breaks out of the support level that is basing the neutrality, which means the breakaway gap breaks resistance, it breaks support, it breaks the pivots, and it starts something new. And so when you have that neutral condition and then you see the market gap up and secondarily run away from the gap, that would be the commonality of a breakaway gap. So number one, we have neutrality in some capacity going into the gapping situation. Number two, the gap gaps outside the range of neutrality and runs away from the price. Does that make sense, everybody? Just give me a yay or nay on that. It's a momentum it's a momentum trigger. Murados. Yes. Yes. Breakaway gaps are very powerful trendsetters. Yes. And when you and it doesn't mean, guys, that once you say, oh, that's a breakaway gap out of a breakaway range, let's go jump on out of the money call options and go to the moon. That's not what it means. What it means is that your next trade setup you should be hunting here is bullish patterns. Whether that's high inside candle development, whether that's bar by bar action on the momentum trade side of it, or whether you're waiting for some degree of bullish pattern. The breaking out of the range signifies you're now in a bullish uptrend. You don't know if this is going to be the tippity top. You're looking for the next pattern. We'll talk about that here in 1 second. Now, a breakaway gap, just to give you a couple examples here as case studies, you look at this neutral situation right here. You got neutrality on the trend, a little bit of base consolidation, pivots are right there, resistance kind of basing underneath. The breakaway gap occurs, volume increases. I didn't mention volume on one of the things you want to look at, but typically speaking, all of these types of gapping situations, whether you're talking about breakaways, exhaustion, or runaways, they all have increasing volume to them because they're all done on catalyst events to get the market united on the overnight action that causes a gapping situation at the cash open. And so neutral condition going into the gap, you gap above the neutral condition, that creates a breakaway gap situation. The trend now continues to move in the direction of the gap. Now, on the downside, works the exact same way, guys. The exact same way. Gaps don't work differently on the top side versus they do on the downside. Breakouts of resistance are the exact same thing as breakouts of support. Flip the chart upside down and you got the exact same situation. You got some degree of neutrality here. You got support that is just kind of basing. The announcement comes out. You gap. You run away from the price. That means you're going to be looking for some continuation analysis. The break is in the direction. This starts a new trend. This is kind of like that breakdown trigger here. And you would most likely wait on a couple days. And in this situation, the couple days of consolidation here. And the reason that's important here, guys, on the gap is because a lot of times these gaps are based on volatility events. And a lot of time it takes more than 1 day of pricing to kind of remove the volatility from the equation. It's what I refer to as a secondary pattern following the earnings, following the news, following whatever sparked the catalyst or the catalyst that sparked the buying or the selling pressure. And so the gap tells you you're looking for a trade. The pattern tells you when to actually make that trade. So what is the trend? Pop quiz, everybody. What is the trend that occurs before a breakaway gap? Is it bullish, bearish, or neutral? You're in a trading range. And when it breaks out of that range, you see it as a catalyst that is starting a new trend. Does that make sense, everybody? Gotcha. Okay. Now, the runaway gap and the exhaustion gap is where it gets a little confusing because the commonality between a runaway gap and an exhaustion gap are identical going into the gap. The difference is what the price does immediately following the gap. So in a runaway gap, gaps are in the direction of the existing trend. So you already have some degree of existing trend, whether that's bullish or bearish is indifferent to this conversation. You have some degree of trend that already exists. And the gap will typically be in the direction of the prevailing trend. Now, the ultimate question is, if the gap is in the direction of the prevailing trend, what is the difference between a runaway gap and an exhaustion gap if both of those things are identical? Remember, when you're reading a gap, it takes two parts of the analysis. One is the trend in front of the gap. Two is the price response immediately following the gap. For example, In a runaway gapping situation, oftentimes you have a trend that is already in process. It's already in progress. Whether you're gapping at the tippity top at resistance or at support doesn't matter. You have a trend. That's the important part of the equation. Now, that fits a runaway gap. You have a bullish uptrend, you gap. Now, the difference between a runaway gap and an exhaustion gap, in my estimation, is not the trend that exists before the gap. It's what immediately transpires after the gap. After the gap, you see the gap here. If the price runs away from the gap, meaning the gap is up and price moves up, that is a runaway gap. You're running away from the gap. And so when you're looking at a runaway gap, this is pure momentum. You're looking at the gapping situation and the market runs away from the gapping situation. That's the runaway gap. And so when you're looking at a developing trend here, it gaps up. This would be a breakaway gap, quite frankly, not a runaway gap. You have some degree of neutrality, sets the breakaway gap. Now that the market is already in a trend, this gap would be a runaway gap. And as you can see, market runs away. In the bearish downtrend, you see the trend going down, 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 down. Price gaps down, price sells down, continues to run down. And so the trend going into the runaway gap is very similar to the trend going into the exhaustion gap. The difference is when it gaps, does it run away from the gap or does it contract and start pulling back immediately as investors say, nope, thank you for the gift of the trading gods, and I'm going to lock in that profit. When the investors say that, we typically see the gap start to close and the gap start to come down, and that, my friends, is what we call an exhaustion gap. And so when you're looking at the key difference between the runaway gap and the exhaustion gap, the breakaway gap is a pretty simple one. You got base neutrality going into the gap. The runaway gap and the exhaustion gap are where it gets a little bit different. So on the exhaustion gap, once again, very similar situation. You have a trend going into the gap. The difference is what happens to the price after the gap. Price gaps up and immediately starts selling off. Price gaps up, immediately starts selling off. Price gaps up, nobody trusts it, nobody likes it, nobody holds it. Everybody's like, oh, thanks for the gift. Price comes right back down and fills the gap. And so the exhaustion gap will gap up, but your expectations here is that the gap is going to fill, which means there is a little bit of a counter trend here, trade, between the low price of the gap and the top price of the top price of the candle on the gap going into this. That's a level that can be traded there. And so the difference is very important because on a breakaway gap and a runaway gap, you're thinking bullish on when they gap out. On an exhaustion gap, you're thinking about that gap getting filled and maybe something even more underneath that. So you have a trend going into it, market gaps up, does not carry the bid, comes right back down, and you see that gap fill and then some. Market's trending down, gaps down, doesn't continue, immediately reverses course and fills that gap. And so when you're looking at the four types of gaps, you have common gaps, which are frequent. And do common gaps fill? Yes or no? Do common gaps fill? They're an imbalance. Common gaps all fill. Every common gap fills. Everybody type yes. All common gaps fill. Every single one. Nope, not typically. Every single one. Every single one. It might not fill that very second, but they all fill. There's just an imbalance, and so they don't have a lot of volatility to them, which means they don't really give us a big read. They're not a big part of the conversation. Runaway gaps. Do runaway gaps have a tendency to fill? Yes or no? They don't. Not immediately. Not immediately. They certainly can over time, but not immediately. Breakaway gaps. Do breakaway gaps fill? Not immediately. Not immediately. Exhaustion gaps. Do they fill? Yes. Yes. Now, what's more important to the analysis? Is it the trend going into the gap, or is it the immediate price response following the gap to help us understand if it's going to fill or not? It's the price response. A lot of commonality, especially between the exhaustion and the runaway. So what I want to do, guys, is I'm going to pull up a bunch of stocks from this recent earnings season. And you guys are just going to tell me, is it a runaway gap? Is it a exhaustion gap? Or is it a breakaway gap? Does everybody understand the game? That's all we're going to do. We're just labeling the pattern. That's it. Gaps are just a pattern, guys. It's just another pattern we have to memorize. That's all they are. Okay. So, and if you guys want to pull up any gapping situations, please pull them up at the end. This will take us a few minutes. I'll leave some time at the end of the lab for anybody's questions here on gaps or anything, guys. If you have any question, more than happy to field a little bit of a Q&A at the end of the lab here today. All right, let's go to Meta. All right. Now, you're going to be able to see the overall price response, and I'm going to remove the moving averages from the equation so that we can just take a good look at the overall price. All right. What would you call this? A runaway, a breakaway, or an exhaustion? I would call this a breakaway, personally. The reason I have this as a neutral trend going into the gap. You see how we're just kind of some degree of base neutrality? Not really a statistical edge here on support or resistance. And so when you break out, you start a new trend. And so you obviously gapped on big volume. You can see the volume spike here, right? You gapped on big volume. You got underneath the range, and then you ran away from the range. So this is a breakaway gap. Now, does that breakaway gap now mean that the next move is obviously down here as well? No, that's what it's here. Now that pattern has come to a conclusion, and now we're fresh looking at it, seeing how the market's going to develop at 600. Now, I would say keep an eye on that 600 level because there ain't a lot until you get to about 540 on Meta. And that is a terrible M formation, and that is terrible volatility, and I would not be picking up falling knives. Something my old man taught me many, many, many times. Do not catch that falling knife, son. Let it hit the ground. So, but does everybody understand the gap? We don't need to get into the next move here on Meta. Does everybody understand the gap, why it's a breakaway gap? One, neutral condition, breaks out of the neutral condition, market continues to move in the direction of the gap. Is everybody good on that one? Awesome. All right. Let's go to Cisco, CSCO. This one is a little bit more complicated. What would you label Cisco's gap here? Cisco just reported earnings. I want everybody to answer. Give me your best guess. Okay, exhaustion, runaway. Yeah, I think this one's a little complicated. I would say it tested up, started selling off. You're really kind of middle of the range here, so I'm open. But I would officially, personally label it an exhaustion gap. Personally, that's how I would. But I do think it's a debatable one. I do think you can make an argument on the runaway side of the equation, but you can't make an argument on breakaway gap. It's either a runaway gap or it's an exhaustion gap. Can anybody tell me why I say that? It cannot be a breakaway gap. It either is a runaway gap or it's an exhaustion gap. Why? It, that certainly helps, guys. Absolutely, because you closed underneath where a red candle on the gap will give you a little bit of an exhaustion fill. There's no doubt about that. But the reason it has to be a runaway or an exhaustion gap is the condition going into the gap. You had a trend going into the gap. You have a higher level of resistance right here, and you have a higher level of support right here. And so, as you have a trend going into the gap, you therefore have this listed either as a runaway or an exhaustion. Because the market tested up, sold off, some of that was market relatable, to be honest with you. I'm willing to bet if the market was a little bit bullish today instead of rip your face off bearish today, you probably have a little bit of a different conversation. And so I'm open minded to it. But I think what will cure the debate is if it ever goes under today's low. If it ever goes underneath today's low, doesn't that confirm exhaustion? Like, doesn't wouldn't that confirm? Yeah. And so, like, if there's ever a debate here, guys, if it clips the low point here, you gotta think exhaustion because that's exactly what it's starting to do. Because it kind of, I do think the context for the market today is important to understand because it was testing up, then the market got the rug pulled today. Yeah, like literally, I made a comment on Twitter today. Rug pulls everywhere, like literally everywhere. And so I want to be open minded to Cisco here. It is a positive gap on a positive earnings response with a good increase in guidance. So it could be marketable relatable. And when I'm in doubt, all I say is, well, if it gets underneath the low, expect that gap to fill, and then let's have a conversation at 74. Does that make sense, guys? So for me here, I would just say, you know what? If it ever gets to 74 or 75, let's start talking about a pullback. But as of right now, I would consider it an exhaustion gap with an expectation of that gap to fill. Let's move to Comcast here. They had an interesting gap to the downside. Now, what would you consider this gap on Comcast? Are we a runaway, a breakaway, or an exhaustion? This one really has the feel of exhaustion. Yeah, this one really has the feel of exhaustion. Number one, I think we can all agree we're already in a trend here. You gapped away from the trend and it powered move off that. That is the telltale sign of exhaustion. When you gap down and gobble up, everybody write that one down. Gap down, gobble up. That is signs of exhaustion all day long. Gap down, gobble up, get into the bull move very quickly. And now you can start thinking about that bull move there. And then when you couple that with an understanding that Comcast gapped into some very well-known levels over here on the chart. And so there was some causation technically for that one, but I would definitely consider that an exhaustion gap, which means immediately following the gap, once it starts going back up, I'm not concerned necessarily about the continuation to the downside. I'm more concerned about what gets developed either here at the 28 level or probably most importantly here at the 29 level. And so exhaustion gap puts it on the radar for a bullish reversal here. A mean reversal, I think you could consider that. Yeah, I mean, you are reversing back to the mean. Um, but I would actually suggest it's more than that. I would suggest because when you're reversing to the mean, you are just expecting it to reverse to the mean, and then you're going to be looking at a bear here. Because if it gaps down, reverses to the mean, that's what I call a bearish retracement, quite frankly. So it's a little bit of that, but I do think it's a little bit more than that as well. All right, so Comcast here, gap down, no sell down, powered back, got gobbled up. That's exhaustion, fill. All right, good job, guys. Good job. Are you starting to understand gaps a little bit more, by the way? You guys enjoying the lab so far? Awesome, awesome, awesome. Okay. Let's look at a couple more. Here's one. D-Dog. I call these Delta Dog. They're actually Data Dog. They're an AI play. Um, Data Dog here in the tech space. Just look at the gap. Would you consider this a breakaway, a runaway, or an exhaustion? I'd call it a breakaway, but I do think you can make an argument for runaway, Morodos. Like there's in gapping, there's scientific data, and then there's analytical data, and then there's kind of the, I mean, you can debate this. Are you already in a trend because you had a, higher level of resistance? I would give it a breakaway, just given the fact that right before it did break away there, you'd actually held resistance. So do you see how this resistance got held right in front of the gap? That creates this as neutrality. And so you could argue it's runaway. You could argue it's breakaway. I'm going to argue it's a breakaway gap, but there's not a substantial difference in what your expectation is when you're suggesting breakaway versus runaway. Like we're having an argument over the exact same analysis. You know what I mean, guys? Like if you're like, no, that's a breakaway, and one trader's like, no, that's a runaway, and then another trader's like, that's a breakaway, and like the other trader's like, well, kind of same team here. You know what I mean? We're looking at the gaps on the daily chart just to make them easy. We do get gaps intraday, and it can be treated very, very similar, but we are looking at the daily gaps here just to make sure that we can see some significant gaps based on earnings. All right. Now, what really signifies it for me, what settles it for me, is when the market runs away from the gap. Once again, market running away from the gap, not only did, and think about it like this, guys, not only did the investors cheer on the earnings report, not only did the investors sit through the gap, not only did the investors not profit take off the gap, but the traders who really drive price action from the open to the close, not investors. Investors are not driving Data Dog from the low point on the gap to the top point on the gap. That's traders that trade Data Dog. And so it's the investors that create the gap. It's the traders that really come in after it. And when you got the investors celebrating the gap and the traders pushing the edge on that gap, that's bullish momentum. You got multiple time frames of traders all simultaneously looking at the same thing. And yes, that is a breakaway gap. Now, which means what? How should I be trading this pullback? If Data Dog's on my watch list, should I be looking at this pullback for an opportunity to find support and make a bullish trade here? Yeah, I'm on the radar for a bullish trade here. No doubt about that. The breakaway gap signifies a new trend. It officially established a higher ceiling at 200. And now I'm just personally treating this as a bullish retracement. I don't think you should ever be aggressive on the gap itself, Murados. I think the gap is what starts the pattern analysis. And in fact, a lot of these are volatility events. You have to have a volatility event to create, to unite the entire market to be buyers or sellers simultaneously. And so these are a lot of volatility events. And my personal rules are that on a swing trade, specifically on a swing trade, I don't trade 2 days in front of an earnings, and I don't trade 2 days after an earnings. I want to give the market a little bit of room to breathe to develop that next pattern. Remember, the gap tells me what if am I bullish, am I bearish, is an exhaustion, runaway, or breakaway. That doesn't mean I'm making the trade that very second. It just tells me what I need to look for. I track Data Dog. This is a stock I track very, very closely. It's on my AI Gold Rush watch list. It's going to be on my next edition of the AI Gold Rush watch list. Those are the top 25 AI names in the market. Data Dog is one of them, quite frankly. And so when Data Dog, it's on my watch list. When it breaks out, gives me that edge. I'm not going to make the trade here. I didn't even make the trade here. I'm waiting on the next pattern. And the next pattern is either going to be a cleaned up high base at 200, or a pullback back down to 180. And either way, I'm here for those two conversations. And so as the market is now pulling back here, I'm just waiting on a pivot formation. That's it. The gap told me to look bullish. I'm looking bullish. And so I'm looking at whatever that next pattern. That next pattern was a high base because the volatility is bringing it back down into a retracement. I'm tracking the retracement for a potential pivot. Let's look at another one here. General Motors. What would you guys consider that gap on General Motors? Would it be a runaway, an exhaustion, or a breakaway? I think it is a breakaway. I do. I do think you can make an argument for runaway. I think you can. What I don't think you could do is make an argument for exhaustion. Can anybody tell me why you cannot make an argument for an exhaustion gap here? I think you can argue breakaway or runaway, quite frankly, but why could you not make an argument for exhaustion? Yeah, full port open worked. That's a great way to put it, Ace. Uh, Again, whether it's runaway or breakaway, because we are breaking out to some degree of neutrality and there is some degree of bullish uptrend, but you run away from the gap. And when you run away from the gap, once again, you have investors celebrating, not profit taking. So the investor class is like, oh, yeah, we're happy. Let's giddy up. Let's go, go, go. The traders are like, oh, I like this. I like this. Again, you have a momentum condition. Does that mean you make the trade on the gap? Because I made a trade here on General Motors. Did I make the trade on the gap? Yes or no? No, I did not. I did. I was prepared at 70. I was RQ. Absolutely, I was prepared at 70. In fact, I was ready for a close above 70 and I was going to giddy up and go above 70. Absolutely. Because this is a high base. This is a secondary pattern. It never did it. It started pulling back. I got in on this candle right when it got above that level right there. There. By the way, I am still in the General Motors trade. Is that serious? Because if that's serious, I like you and me just had a bro mode moment, and I was like chest bumping and high fiving, and I love that. So you're now starting to understand my language. I like it. Have you ever seen the movie 13 Warriors, where the one Persian guy can't understand the language of the other 12? And then all of a sudden he listens and then understands. You guys should watch that movie. It's a good movie. Um, Anyways, for me, we did become best friends. This was a moment for me in RQ. Yes, yes. I love this. I love this. Okay. After a gap, guys, it's for me, it's always about that secondary pattern. I was listening to Steve on Tuesday. I didn't catch him on Wednesday, but I did listen to his stream on the last 30 minutes or so on Tuesday. And he was talking about the differences between scalping and pattern trades as a day trader. And my head was just nodding along because I was like, yeah, I have this conversation all the time. I have it a little bit different than Steve, obviously. We're different from that perspective. But I kept hearing him say, no, that's just a scalp. That's just a scalp. That's not a pattern day trade. And I kind of find myself talking about that a lot, saying, oh, that's a good scalp trade. This got to wait for a better pattern for a day trade. Same conversation happens for swing traders here on gapping situations. It's really you can always take the momentum trade on the gap. I just don't favor that. I love to see patterns develop and patterns such as high bases, flag-based patterns, retracements, cup and handles, ascending triangles. They all have certain commonalities that my analytical mind can really attach step by steps to. And so step one, you get the gap. Step two, wait on the secondary. Step three, this. And so I love secondary patterns after a gapping situation. This would be the first one. It never confirmed. Then you track the pullback. Pullback did get confirmed. let's look at one more, and then I'm going to throw it to team time here for a second. Z2S, Zoetis. What type of gap do you guys think this one is? I think it's a breakaway. Yeah, which means traders are looking at this point right now. Are they looking ultimately bearish or bullish right now? I'm not saying they're in a trade right now. I'm saying what are they looking for? Are they currently looking for bullish development or are they currently looking for bearish development? Because I don't think the development's done yet. What do you guys think? If you have it labeled as a breakaway gap, you got to be tracking that next bear trade because this sets a trend. Now, it might take a minute. Well, I don't know about you, but I ain't going to touch that type of volatility. I want to see that one get worked out. But anyways, I wanted to spend a little bit of time today just talking about gapping situations in general, going through a bunch of case studies, but really, truly just having an understanding of what are gaps, what are the types of gaps, and what are the commonalities in those gaps. Are you talking about the gap this week on AMD? Or are you talking about the earnings gap? Or not the earnings gap. This was the OpenAI gap. Yeah, this one. I personally had this one as an exhaustion gap. Excuse me. I personally had it as an exhaustion gap, even though commonality in front was a runaway gap. I didn't like this, honestly. I didn't like this. I didn't like it gapped all the way up and sold off very, very aggressively. I was actually looking for a gap fill under. Never occurred, but that's what I had it as, was an exhaustion gap. I was pleasantly surprised when it didn't do that, Ace, because that helped a lot of my other trades. But I personally did have AMD as an exhaustion gap on the OpenAI news. Didn't work out that way. Actually developed pretty good. And then when the market broke out, this thing was expanding pretty good, but then the market turned over. AMD's basically tracking the market right now. But yeah, that's what I had AMD as. I would say I feel the same on AMD. AMD's got some valuation nonsense right now. But 105, that's sexy, brother. That's sexy. Did you guys have fun today? Did you guys learn a lot today? Thank you, Nacho. Thank you. Thank you. Thank you. You guys are the best to teach. You know, every single week. Oh, man. So you're not just listening, but you're truly hearing me? RQ, man, we are like, what's that movie? White Men Can't Jump? That's you and me, RQ. We're stepbrothers. We're white men can't jump. Like that's us, brother. Thank you, Gabber. Thank you, Gabber. If anybody has a stock, has a gapping situation, or has a question, guys, I'm going to leave it open for a couple minutes here. Yes. I wasn't talking about the new one. That new one's not good. The old school Wesley Snipes one, fantastic. NQ filled a lot of things today. It did. There is no doubt about that. You look at the intraday chart here for a second. Like I said, we don't get a lot of gaps in the futures, but we do every now and then in the ES. So, for example, on the futures open on Sunday, we had a gap. What type of gap would you have considered this on the 5-minute chart? That's runaway gap. Exactly. Which means the very second this level was basing and holding, you like this running away from it. Yeah, this is a good runaway gap. Good run going into it. Gap, hold the gap, base, never come. That's good. That's good. So like you don't get a lot of gaps. We do on the futures reopen every now and then. We do on the Sunday open. There's been a couple powerful ones recently on the Sunday open, but a little bit due to some of the issues we've had dealing with recently. But with that said, guys, I had a tremendous amount of fun here today. And thank you so much for being the best part of Blue Sky. Blue Sky is absolutely nothing without the community, guys. And you guys are the heart of the Blue Sky community. And it is a pleasure to be one of the coaches. It's a pleasure to be with you guys here every Thursday to work on our technical financial IQ. And with that said, I hope everybody has a wonderful rest of your day. And if you need anything from us, let us know there in Discord. Thanks, team. Anytime, Nacho. Thanks, Ace.